Welcome back, Conscious Investor. I am so excited to have someone who is an expert to speak about funds. There are so many options when it comes to investing, and they have different upsides and different downsides. And we have to be looking at both of those really pragmatically. And that's why I'm really excited about having Patrick Grimes, a friend of mine, on the show. He understands real estate inside and out. And because he's experienced real estate investing for decades and went through the, the '08 debacle and such, it really gives him a perspective that is unlike a lot of other investors who've joined the game in the last decade, in the last 7 years, even. And so I love his perspective. Patrick is coming on. He's going to be talking about funds in detail. He's going to break apart what's a joint venture, what's a syndication, and what is a fund. What should you be looking for in a fund operator, and how does that fund work? What are some of the peculiarities that are common to those funds? He's also going to show us in real time, because he has a fund that he runs, and it's a powerful fund. You're going to want to listen so that you can see the creativity that real estate allows for and accommodates, and how Patrick is just keeping his finger on the pulse of the market and saying, okay, this doesn't work. That part of that season of real estate investing is no longer producing the returns that we're looking for. What is going to work? And so he is looking at, hey, this is what the next 3-4 years look like, and this is how we are going to really catapult our investor returns. So conscious investor, I am not into fast money. I like money that is stable, safe, and secure. That is all air quotes, because nothing is really stable, safe, and certain. However, we can look at things as much as possible for those hallmark traits that would demonstrate that. What I appreciate is how Patrick is going to show you in the funds that he is operating, how they are producing just a little more stability into investors' portfolios. If you're curious about funds, how they work, how they operate, this episode is 1,000,000% for you. Hello, Conscious Investor, and welcome back. I'm your host, Julie Hawley. For over 4 years, I've paired my background in real estate investing, education, and coaching to create powerful content for you each week. This podcast is where we take a holistic approach to investing by focusing on 3 ingredients to a life of personal freedom: health, mindset, and wealth. We'll talk about everything from passive investing through syndication and how to use your retirement accounts to boost your investing, to mineral balancing and gut-brain health, and into topics that cultivate your inner strength and resilience so you can thrive regardless of any of life's current events. And yes, those are all episodes currently available and linked in the show notes below. Join me each Monday for a mindset episode, and later in the week for an interview with expert investors and health professionals, so that you can experience your greatest health, strongest mindset, and build the wisest wealth. Oh my gosh, Patrick, I am so excited to have you here back on The Conscious Investor. You're one of the very rare repeat guests. So you're an alumni, and that's super exciting, but welcome
Huge.
back.
I'm glad to be here. It's good to be hanging out with you again, Julie.
Yeah, absolutely. I always enjoy our conversations when we see each other at events and everything. And it's great to have you back on the show. You're someone that I trust, with, just investment philosophy in general and how you structure deals. So I'm excited, but we got to start with the opening question. As always, Conscious Investor. Patrick, who are you and what do you do?
A bald guy that shaves his head every day first. Before I started investing, I had hair, and now you know when it happens. So,
Oh,
you know, I
no.
I am the CEO, founder of Passive Investing Mastery, and that is a company that helps provide alternative investment to accredited investors, busy professionals like I once was. I was a high-tech paid professional in machine design, automation, and robotics, and trying to learn how to diversify, not just the startup stocks and retirement accounts. And I didn't know where and how to do it. So I went on a long journey, lost some money, made some money, and figured out how to invest with recession resilience and diversify into non-correlated or allocate into things that aren't all down all at once. And So we now have some awesome opportunities in recessionary times that help investors win for the upside of downturns, and that's really what we're about right now.
I love that. And the first time that you and I ever met was at an event in LA. And it's so
Mhm.
wild to think about that. It was so long ago at this point, like so many years ago. But it's great to see the trajectory and momentum that you've gained over the years and the many successes that you've had. You had mentioned, as you're talking about just exploring different ways of investing. What were some of the ways that explored on your own before going into active an active role in the multifamily and real estate space?
Yeah, so when I was an automation and robotics engineer, I was working in places like, Tesla, did solar cells for Lockheed, did medical devices for Johnson and Johnson and Abbott, and there was the theory, the investment theory of all these people working real hard, real sharp, very, very smart people working in the Silicon Valley and all these startups and the bigger companies was, put it away in your 401k and invest in company stocks or play the game in the stock market. And I was fortunate. So that's what I was doing, but I was fortunate to get some advice early on. And that advice was as early as you can and as much as you can, invest in real estate. And that came from the founder of the high tech company, the first high tech company I worked for. Actually, he still invests with me today. Actually, great guy. He said although he made money in high tech, he actually invested it all and made his wealth in real estate. And so that got me on the path. Now I took the young and over exuberant approach, and I did my analysis and research, but I invested into pre-development, lost my ass, lost everything during 2009 and 10 in the global financial collapse. The loan that I did was personally guaranteed. Quickly became underneath it. Was paying out of pocket. The property wasn't worth anything. The developers went bankrupt, and I had to exit out of that. Came tail between my legs. It struck. It hit me pretty hard, but I learned my lesson on investing, right, for cash flow, investing, not speculating, and
Yeah.
lower risk debt products. I was a talented engineer. I had a master's in engineering and business, and so it wasn't long before I was, back on my feet looking for a place to invest. And the breadcrumbs of the wealthy lead right back to real estate. So, I did that in recession resilient markets that time. I wasn't, doing it in California. I was doing it in Texas and buying existing single family homes that just needed a lift, doing some renovations and holding, refining out my capital and holding. It's like the Burr method, but before I knew what the Burr method was. It was just I was
Yeah.
moonlighting it, right? And so I built up
Yeah.
that, and then eventually moonlighting that didn't work so well when I met my soon-to-be wife, whom you know. And at that point, I told her I was going to do single family, and we got married. I traded up to larger assets where I could partner, and ones that scaled, which allowed me to be able to leave engineering. And that was in building the multifamily portfolio. We did some energy investments. Actually, my family has some energy trusts. I don't know if you know that from. So we've kind of been in energy, and also we have a debt fund and an acquisitions fund. So there's definitely diversification there to help round out our investors' portfolios.
I always appreciate it when people have very clear memories from the last crash,
Mm.
because it doesn't matter if you were paying attention, doesn't matter if you lost or you held or anything. It just matters if you were aware and you got the lesson of invest. I loved what you said. You said investing, not speculating. And so many people leading into that crash were speculating and like, oh, it's just
Mhm.
going to keep, this is going to be great. It's going to be good. Let's just keep going. And so I appreciate that lesson learned and that's why, having strong guests like you on the show, where we can't just amplify voices where, they don't understand that key principle right there. It's so foundational and so important, especially in the times that we're in. You are so well versed in funds. You have funds, and I know with your engineering mind that you are extremely meticulous and detailed in everything that you do, which is wonderful, and I appreciate that so much. I'm wondering if you can give. We haven't had anyone on the show in the last year and a half, probably talk about funds, and that is a really big topic. And so here's what I'm curious about, Patrick. I'm curious, if you can describe what is a fund, like the difference between a fund and a syndication, and how do we even vet a fund? I'm giving you all the information up front, all the initial questions, and then we can go from there.
Well, first of all, this is not legal advice. I'm not I'm not an attorney. I'm
Yeah.
sure they might have a different, but so the word syndication, to my understanding, is thrown around, meaning that if Julie, if you and I went to go buy the house across the street, right? I don't know what street I'm talking about, but the house across the lake behind me here,
Yeah.
and we were both active, then we could be joint. We could be joint owners and operators. We could be partners, right? We can do that together. Call it a joint venture, right? And that means we both have controlling interests. But what if I said to you, hey, Julie, I want you to get, I want four of your friends to put in 50 grand each, and then I'm going to put in some, but then you're totally passive, and you're not going to you're going to have any control rights. You don't have any decision, but at the same time, you're limited in your risk because you're not the operator. So I'm going to limit your risk to how much you've invested in the deal. You're not unlimitedly liable for the loan amount. I'm going to sign on the loan. You're not unlimitedly liable for a lawsuit. You're limited a partner, right? And so when you have that limited partner and you have that active sponsor general partner, you kind of syndicated now, right? You like split it up into a bunch of other people, right? And so the fund, the funds that are out there allow a legal structure by which to participate in those kinds of investments. And there's a lot of different types. The most common ones are Reg D offerings that you hear about. There's like Reg A. Grant Cardone has a Reg A, and the benefit there is you can go to you can almost go to anybody and ask for little amounts of money, right? But
Mhm.
the negative there is you're going to anybody and asking for little amounts of money, right? You're not going for any level of sophistication, any level of net worth and liquidity requirements. So then there's Reg D, Reg D funds, which are the ones that we hear and see about more often, right? And there's a Reg D B, and then there's the Reg DA, or sorry, there's the Reg DC funds, right? And then so the Reg DB funds are the ones that are for non-accredited investors, and the Reg DC funds are the ones that are for accredited investors. And so those are the ones we see. Now, when you say fund, any one of these syndications that are stood up are a fund. The majority of them are Reg D 506B, and some of them are Reg D 506C, like we do, that allow credit investors only. But when you say funds, which you often mean, or when people say the word fund, what they think about is, well, is it a two different things? Is it a feeder fund or is it a fund of fund, right? Meaning, even though every syndication ran is technically a fund, and a Reg D 506B or C are the common ones that we work in, people don't consider that a fund. They consider it a fund if this offering is not just buying one asset, if it's buying lots of assets, or it's open for a long time, or it's open and closed, or if it's a fund of funds, meaning you got one fund and you got more funds underneath it, right? But it actually turns out that all syndications are actually funds. And so when you say funds, maybe you mean fund of funds, right? Meaning that I'm going to go create a fund, but I'm going to go invest in other funds too. And then it's a fund of funds, right? If I create a fund and I have feeder funds, which are special purpose vehicles set up just to invest in my fund, right? Then that's technically a fund as well. It's a fund of fund as well. So I don't know if that helps, but the benefit of building an open fund, right, or a blind pool open fund, where that means that you have an investment thesis, you don't have an asset yet, right? But you have an
Right.
investment thesis, and with that thesis, you're saying, I'm going to go buy this kind of stuff. Yeah, you don't know what it is, and you don't get to approve it, what those are, because you're a limited, but you're going to give me the money, and I'm going to go about and do this. There's some benefits to that structure, right? But then you got to find the investors willing to kind of relinquish control, right? And so our debt fund, which is the real estate asset-backed debt fund, it is a blind pool open fund, meaning people can subscribe and they can redeem, and they can subscribe and they can redeem. We put, hey, these are the kinds of loans. We're senior secured, where loan to value is no higher than 65, we're trending 40 to 50. We're going to go out and invest in all these loans, right? And so that's a fund of fund. Our acquisitions fund, similar. It's a fund of fund, blind pool, and we're saying, hey, we're going to go buy things in cash, right? But I mean, that sounds cool. But you don't get to know what it is because we just closed on our last one in 14 days. And so we're not going to go ask for permission, right, to do
Yeah.
that. But here's the deal. Here's the projected returns, and here's the guardrails by which we're going to spend the money in the fund, right? It's a blind pool open fund. But that gives us the benefit to really pounce when we need to pounce, right? And
Mhm.
then we, instead of just being one asset in the fund, and we push refinance out proceeds to
Mhm.
investors, and when we sell that one asset, we push the sale proceeds out, and they're kind of forced to take a refinance or sell. Being a blind pool open fund means in ours that we can take the refinances and then reinvest in the fund. And then we can take the sale and then reinvest into more assets in the fund. And instead of that being forced out, that when we refinance and we sell and we grow value, it increases the value of their unit price. And so if they want out, they can request a redemption and then we pay them at the new unit price. But it's when they request the redemption. You don't have to be exited in a certain year, right? You're not forcing it out. So there's a lot of benefits in both of those because it allows you to build a large, diversified pool, either in debt or acquisitions, allows you to move very quickly, get the best deal, buy the best notes, originate the
Mhm.
best loans, or buy the best assets, right? You have to find investors that are working with a sponsor that has a track record and that you believe in is going to make the right decisions because you're not investing in a specific asset. But I think it's a lot lower risk. And you can potentially get higher returns because there's latitude given to the sponsors.
This is all super powerful information, and I really appreciate when just how you describe the difference between joint venture, syndication, and fund, and the idea of the blind fund and the pros and we haven't talked about the cons. We touched on them a little bit, but what's interesting also, I'm going to add on the pro side of it is you said it, and I'm going to say it in another way, is it's a liquid investment. So in a syndication, it's illiquid. You're locked in, you're tied up, you're in it through the duration of the hold period. But when you're involved in a fund of this nature, I'm understanding it's liquid. I can go in there and I can say, hey, you know what, Patrick, I want to exit out of this, and my money back. And you're going to give it to me at whatever the value is at that time. So if you've grown that portfolio in the fund substantially, I could exit. And so it really has that same structure. And then I trust you can clarify and like refine this, make it all
Mhm.
pretty, but it's really operating in a very similar way to a stock, to a public investment, where you can trade it in that same capacity. And now
Well, you
I'm going to
can't, there's
pass.
no open market for private placements. And that's what all these
Right.
are. They're private placements. They're not public. We're not, so we're not registering. But yeah, I think you had it right. So now in your liquidity is defined by the documents of the fund, first of all. So
Hmm.
not all funds are like that, right? Some may say we're going to buy a bunch of assets. You don't get out until we push it all to you. They may say that and it still be a blind pool open fund. Now, the debt fund we know people want liquidity right now, right? We're getting really high interest rates in first position loans, and it's opportunistic to do that. It's not normally good to do a ton of debt, but right now the interest rates are really high and banks are pencils down. So let's jump in there and let's do some debt. But like we have 90-day notes, 180 in 1 year, so they can roll 90 days forward, half a year or 1 year forward, and they can exit at any one of those increments, right? Or we have a 3-year lockup in the debt fund, where if you're doing a Class A, Class B share, it's on a note. You can join in through 3 years. And after 3 years, you can request a redemption. We have the same 3-year lockup in the acquisition fund. We do need the capital for long enough to produce the projected return, right?
Yeah.
You can't come in and out. And actually, the securities doesn't actually allow for less than a year. They don't want you to trade in and out of these things.
Okay.
And so there's guidelines around that, and that's why the debt fund, in order to do less than a year, we actually have notes, right? So you're getting a note from the fund. It's like you're loaning the fund money because we in order to be compliant, you can't really do those shorter term. The benefit is the notes are like fixed interest, right? You get a fixed 7, 8.5, or 10, right? It's really cool. But on the Class A shares, you get a lot of upside, right? Because you get to participate, kind of the preferred return and promote the split of the profits. So same thing with both funds. Those are all things you have a lot of latitude in these funds to be able to do almost anything you want as long as you disclose it in the fund documents and then disclose, right? And so that's what securities attorneys are for. And that's why the private placement memorandums are so long. It's that kind of how do we confine it to the point where we build trust with the investors that they know what we're doing, and but then leave it open-ended enough for us to be successful, right? And
Mhm.
pivot when we need to pivot. And that's
Yeah.
been the case, right? Because a lot of the funds right now are struggling because they need to do
Yeah.
capital calls or they need to do something because, and they weren't prepared for rising interest rates or
Mhm.
taxes or insurance, right? So you got to be careful as a sponsor. You want to narrow it as much as you can without narrowing it too much. And as long as it's disclosed, you can have latitude to build your fund almost to do almost anything.
I love all of the flexibility that's involved with funds. I've sat at some tables with some some of our friends where it's just amazing to see the opportunity and how it can be such there's so much upside for investors. One concern I have, and this is definitely not with you, and it so one concern I have, and I'd love to hear your sentiments on this, is that just like when everything gets easy, everyone seems to flock to it and do it. And they want to be like, oh, you know, hey, I'm now the master of funds. And they don't have the same you're dedicated to learning, knowing, understanding before you take action. Like you're like, no, I'm gonna know what I'm doing. Not everybody's like that, which is why we see some messes out there in the streets right now. So how do we vet fund managers, particularly in the real estate space?
That's a really good point, and because I actually tell people, and were we on a panel before at Deal? I was on a panel. You were hosting at Dealmaker Live, I think, and it was about how to vet sponsors, right? So me and you have had this intimate conversation before, and so we go through the gamut. So I like to say that because I come from the operator perspective, right? So I vet partners through the crucible of getting things done, right? And I
Mhm,
travel out, I do the due diligence, we do the underwriting. You see who
mhm,
really shows up and stays at the table. But as a
mhm,
limited partner looking away into alternative investments, it's tough, right? There's a ton of different opportunities out there. There's a ton of different sponsors, and you you need to spend the time to get to know the individual. You need to ask for
mhm,
references from other investors. You need to ask them for background checks, and then wonder why they're saying no to you if they are. You can ask them questions. Have you ever been through a bankruptcy? I can say I haven't. I almost did back in 2009 and 10, but I fought it. I fought through and didn't, right? But you can look at what past companies, this was a really good one. Look at what past companies they've been involved with, check their LinkedIn, and then you can search those companies for regulatory issues, right? We actually saw one sponsor who had a prior company who had a bunch of SEC violations, and he just created a new company, right? And we're like, oh wow, this is kind of so. I would say, check with their, ask them for their track record, ask them for background checks, ask them for what companies they worked with before, and then what investments have they exited, then cross-examine those. Go talk to other investors. It's not an arduous process, actually. If you're a limited partner out there wanting to learn, you'll probably spend a lot of time learning how to crochet or knit, right? But if you wrap your mind around, oh, this is exciting and fun, it's a way that I get to retire earlier because I'm not going to go for the 7, 8, 9% that's, I'm getting over in the 7% is what traditionally in S&P 500
mhm,
for 30 years. I'm going to go for double that. Well, I can retire and live health. So I'll spend some time meeting other people, talk to other investors, see if they have referrals, right, that they can give you.
mhm.
Googling these, make a game of it, kind of gamify the due diligence process. And if you find that they're not willing, they don't have the time for you, they're not interested in answering your questions, then they're not the right fit for you. And I've run into this before where I have just simply been made to feel bad because I'm asking questions about the recourse loan that they're getting, and I'm asking questions about, what the limit of my risk is,
Mhm.
in the deal, and they're making me feel bad about it. So I actually, I bow out of those kinds of things. Don't take some time, learn, get to know the sponsor, get to know the industry, and do your research.
I stay if I start to feel bad about asking questions, I'm the same way. I just back away because I'm thinking I always tell myself if I'm not feeling great about asking questions right now, if I feel like it's not being received right now, and this is like basically let's just say first date type thing, first, second, third date, then what's that going to feel like when we're 2, 3 years into a deal? Like, no,
Mhm.
hard stop, hard pass, exit the stage right there.
I always tell investors I'm always available. My calendar is at the bottom of every email, and I allocate time
Mhm.
every week to talk to investors. So one of the things that I love about the business, and I do have other people that go through decks and have investor relations, but I'm always there. You can call and text me,
Mhm.
and that's an important relationship. And I think if you don't have that value, if you can't make that time for your
Mhm.
investors, then that says a lot, right? And to your
Yeah.
point, man, this isn't even the first dance. We got a whole marriage to go to
Yeah.
go in the deal. So,
Yeah,
yep.
exactly. You have some really and you touched on it earlier, but I'd like to do a deeper dive into you have the acquisition fund, the recession fund. So I'd love to like actually get the thesis behind those funds. How did they originate? And you can choose which fund you want to start with or how you want to talk about it. But let's just give a real time example to the conscious investor of here's how this looks. Here's a fund and here's what and I think that we're in compliance because they're 506c,
Correct.
so we can
Mhm.
talk about everything quite openly. And if you're a new conscious investor, 506c, it just means it's accredited investors only, like super high level here. And so he can talk about all the details of it. He can advertise it. It can be out in the public. A lot of times my company, Three Keys Investments, we operate generally under a 506b umbrella, which is why you don't hear me talking about investment opportunities until they're closed, unless you are in the investor community. So there's a big difference. And this is a fantastic opportunity if you're a newer investor or if you're curious about funds to really understand real time. Hey, here's a real fund that's really open, and here's what it looks like.
Right. So, yeah, so we since the very beginning, I did Reg D 506C for accredited investors only because I came from the high tech space, and pretty much most of my people that were working with me to create automation and robotic solutions, they were all accredited. So it was natural for me. Most people go your route, Julie, actually. They go Reg D 506B, but yeah, so the inception of the acquisitions fund, right? We set up a lot of independent syndications, and I've co-partnered in a lot of syndications as a general partner. I think there's 5,000 some multifamily units across the Midwest, Southeast, and Texas total now. It's quite a bit. And I think that's spread over 17 different syndications. Some were portfolios of 1 to 3 units, but they were all fixed assets. These are what we're buying, right? Actually, there was one that was 7 assets, but this is what we're buying, and we're going to raise this amount of capital, and we're going to execute this plan, right? And that required, and the analytical engineer in me, right, was really down in the books and calculating and working on the underwriting. And I think that's how we met potentially, and like working in underwriting stuff. And I could see very clearly through the comparables and the market trends, and I could see very clearly a correlation to purchase price, the nearby comparable rents higher, that I could put in a certain capital expense to renovate those units, and get the higher rents. And then with the cap rates and the pricing, way things are trading, I could correlate that to a valuation gain, right? Well, that came crashing down about 2 years, about a year and a half ago, right? Because the ability for me to calculate infusion of capital to rent growth, right, through forced appreciation and then valuation gain became much more challenging. And the reason why is because interest rates started to grow, right? And as interest rates started to grow, valuations started to soften. Valuations started to go down. I mean, because when interest rates grow, then it's more expensive. The debt is more expensive to get. It's harder to get debt on these things, which means people I want a lower sales price, right? And so that correlates together. Inflation hit, and I've got an article in Forbes about how inflation, multifamily is a hedge against inflation, which is still true. The fundamentals are true, but you compound inflation, increasing the material costs, increasing the payroll, increasing the labor for not only the capex but daily operations. Well, that hits more of your income, so your valuation and your income is getting hit too. And then insurance in a lot of the favorable markets like Texas and Florida, that went up almost 30% a year. In some markets it doubled, and in some markets you can't get it anymore. In some coastal areas in Florida,
Mhm.
carriers have just left. So there's been a big, essentially there was just a stepwise function where about, conservative 5% year-to-year rent growth was typical and underwritten as conservative. And now we're at 30% for a couple of years. So all those things kind of affected, and then COVID hit, and then there's just wild delinquencies. And me and my crystal ball is fuzzy now, Julie. Like I can't see far off into the future, even now. Um, Jerome Powell just got on and saying in February 6th this year that the effects of commercial real estate on the banking system is just beginning. So we're going to see a lot of impact from that. So commercial real estate, the valuations are a little uncertain. And what I do know is that I can't underwrite like I used to. I can't see through the crystal ball like I used to, right? I can't calculate
Yeah.
with a high confidence interval exactly in 3 to 5 years where things are going to be. But what I can calculate, what I can see, is that there are really good deals right now that right now I can get at a great basis. And if I pay all in cash for those, I can lock it up quickly, and I've made my return going in.
Mhm.
And then we can trade forward. We can trade out of those within a year or 14 months into another asset that we bought right. And we can do it all
Mhm.
in cash. And to me, I can calculate that because it's short, it's near term, and I'm not trying to hope that a bunch of capex correlates to valuation gain with all
Yep.
this with the lack of confidence in all the variables that would get us there. So the the idea behind um, the acquisition fund was precisely that. It was let's go in cash heavy, right? Let's find these deals from distressed operators. These are people that have performing assets. We got one at a 10 cap, one in an 8 cap, meaning they're cash flowing,
Wow.
but the operators are financially distressed. They're financially distressed because maybe they didn't put enough down on it. Maybe they got a bridge
Mhm.
loan or short-term variable interest loan that skyrocketed. Maybe all of that happened and they inherited the property and they don't know what to do, or they got a divorce, or they're retiring, or there's somebody in their, who knows? But all these things, maybe they're just financially distressed and the economics all of a sudden tipped them over the edge and they need to exit. They want to exit quick. And so our funnel deal flow is strong, but now all of a sudden we can raise capital for people looking. It's a recessionary acquisitions fund, people looking to pounce and potentially participate in the best buying opportunity or second best buying opportunity of our lives. I think 2009 or 10 was the first, and I missed it because I was getting raked over the coals. But that was the evolution, and so far it's been great. All in our first asset, for example, we bought for just around $4 million. It's right after we appraised, right? And it was other offers much higher, but they were going to hopefully get bank debt and close in 60 to 90 days, right? And the banks are just all over the place right now.
Yep.
So we did all in cash. We were able to get a really low basis and immediately appreciated at 5 million. So we got a 25% valuation gain literally on day one. Cash flows on day one at a 10 cap, strong cash flow, and that's 60% occupied. We occupy it without any capex, very minimal to any capex improvement. We just occupy it, and it appraised at 8%, 8 million, right? So uh, and then within a year, we're already looking at listing in April, May this year. So the strongest the strongest strategy, I think, is just to buy as much as you can and exit and then buy and then exit and buy, because we're in a very short window where you can do recessionary acquisitions. And the faster you can churn and burn these, and we can pull out, as soon as we bought in cash, we pulled out our capital with a refi, and we bought the second asset in cash. We're looking to trade 1031 this first asset into a third. And then in each tranche, if we don't have enough, we inject more capital into the fund, and they buy in at the unit price at that time, and we just keep compounding. It's a stepwise function. And it's so calculated in my mind that we'll just, with the day that we can no longer buy that way, we'll just stop, right?
Mhm.
And we can wind down the fund. And so that was really the inception of the acquisitions fund. Let's do something. Let's do it. It's completely different than what we were doing before.
Yeah.
Um, but let's do what makes sense and we can make work and as fast and as much as we can in this recessionary time. And we're going to be able to do this through 2025, 2026, and 2027 easy. But I am definitely not going to put my money in something that's going to lock it up 3 to 5 or 5 to 7 years right now, because I'm going to miss the entire buying window if that's the case. And an investment in the acquisition fund means you're going to get it split up and diced up into half a dozen assets in that time frame, maybe a dozen assets in that time frame, right? Because we're trading it forward and stepping up each time. So that's really why I'm really excited about it, because it's the coolest thing I got going on right now. So that's what we're doing. I mean, that's just the acquisition fund. It's kind of a different story with the income fund.
Well, I love this. I mean, because this is what I love about real estate is that if you are a professional in the real estate space, then you are living and breathing what is the market offering right now and pivoting and saying, okay, wait, that's not the game anymore. Not that it's a game, quote unquote, but like that's not the path anymore. The new strategy, this is going to be the strategy that's going to help us. Like knowing that the ultimate goal is we're here to invest and to, produce outsized returns as much as possible. Stable, solid, wonderful. Well, stable air quotes on that. We can't actually say that. They're not,
Right.
but we want to make that type of moment, create that kind of momentum, velocity of capital there. So, what kind of returns, by the way, is that fund getting? That sounds powerful. Sounds off the hook.
Yeah, even though it's a Reg D fund, I still struggle to returns, but and each individual asset, we don't buy it unless we know we can get a 1.8 equity multiple in under a year. So
Yeah,
the asset by asset returns are very high. So, but if I said exactly what we're projecting with the fund, it scares people away. So I just, very
I get that.
conservatively, north of 20, north of
Yeah.
30% annualized average returns, because if you just, I mean, it's just the sum of the parts is all it really is, right? And
Mhm.
when you're making that return going in, it's each time, it's really hard to not get that on the backside, right?
Mhm. Well, and that's where we make our money when we are buying on the front end.
Mhm.
Like if you're buying it correctly, that's where great, we've made our money right here.
Yeah, but then if you go inject, 5 million in capex to renovate it, you've got to get the valuation north of that, and that's where it's breaking down right now, right?
Yeah,
And
well,
so,
that's what I'm saying. Like we buy
mhm,
buy right, always buy right.
mhm.
Like it's part of my sleep at night policy. I don't want distressed deals in my life. So, just buying things right on the front end, knowing that okay, this is going to work even if XYZ happens. It's going to be
Mhm.
okay.
And I
Love
think
that.
that on the debt fund side, it plays more into the fact that banks are mostly they're in distress right now. And there's nobody arguing that, and there's only more distress coming.
Mhm.
They were way too over-indexed in investments, and as not just office, but other commercial real estate assets that have devalued because of rising interest rates. And the banks are just not getting paid off. Banks have traditionally diversified into bonds, which have devalued because of rising interest rates. So there's a liquidity crunch. So these performing assets, they just don't have lenders coming to the table, or the lenders are uncertain what they can lend at. And so they draw them on 30, 60, 90 days, and they keep changing the terms. So there's a lack of trust in the lending environment. Just like out of 2009 and 10, private credit or private debt really exploded. We're seeing that right now. And
Mhm.
so my partner Lance actually went through 2009 and 10 as a debt fund manager. And I don't know if you know Lance Peterson, super great guy, but he's my partner in the debt fund. And he also ran Verivest, that had two billion in fund administration, mostly debt funds. So we both come from seeing the turbulence of years past. So the debt fund allows us to participate in the lower position on the capital stack, right? When people are kind of they don't want to get in. Maybe they don't want to invest for the upside of the downturn. Maybe they want to
Yeah.
invest for capital preservation and just ride it out, but they can't keep
Yeah.
it in the bank because they're losing with inflation. So what do they do with it? So, if you're at a 50% loan to value loan, which is higher than our average right now, and and the commercial real estate is dropped by 15%, well, you still have 35% above that. I mean, there's a huge valuation fluctuation before the debt investor loses anything, right? And
Yeah.
a 15% reduction in a property value means a 32% reduction for common equity. It means a 0% reduction for the senior secured loan when you're in a 50% loan to value. So the loan to value portfolio, the small balance commercial real estate debt we're doing and performing assets we're originating at 13%. And it's incredible at 13% plus 2 points. And we get to share in those returns. And because we have short term notes with Class A shares and the short term notes are capped, a lot of the Class A shares get to participate in a lot of that upside. And so we've actually been averaging 15% monthly annualized returns since inception to our Class A share members because we're originating at 13, but a lot of the portfolio is only getting, 90 or 7, 8.5 or 10%. So that, we share that, the Class A share members. So that gives the opportunity to really get returns that would normally be like equity, the common equity, the most
Yeah.
volatile, risky side, right? But
Right.
be in a more secured position. And so that's why we call it the recessionary income fund, because in this time, for the next 2, 3 years, when we're still able to originate, there's troubled banks and operators don't trust banks. And we can move faster because we'll still do our due
Yeah.
diligence, but we'll do it more swiftly. And
Yeah.
that we're trusted. We've been around for a long time. People keep coming back. We can originate at higher rates. Let's pass that down to our investors and let's give them a place where they can get great cash flow compounded monthly or distributed. And so that's really the thesis behind that. It's all and they're two sister recessionary funds that provide for that ability to get that upside of the downturn.
I absolutely love it. I mean, there are so many other questions, but we have to start wrapping up, which is so sad. But I love I really value that you are looking at things in such a creative way and also ensuring the expertise behind it and bringing the experience that is critical, in my opinion, is anytime you're investing conscious investor with anyone in a syndication in a fund, you need to know what is their experience, what is their background, what is their track record, what is their character, how are they going to show up at the table,
Mhm.
and ensuring that your best interests are always top of mind. So I appreciate that everything that you're offering, investors right now, Patrick. What is the best way for the conscious investor to learn more about either of these recessionary funds you have?
Well, all right, so
Mhm.
passiveinvestingmastery.com, all spelled out. Sorry about that. Passiveinvestingmastery.com, but it's such a cool name because we want to share alternative investments. We have the funds there. Take a look. You can also set up a meeting with me, and if you do, I give away a copy of this book. I did a chapter in it, and it was an Amazon #1 bestseller. Persistence, pivots, and game changers, turning challenges and opportunities. Had a really great time writing it. Tells my whole journey through high tech, how I tried to get out, got thrown back in again, with tail between my legs, and made my way through do it yourself single to multi to overwhelming. But if it inspires anybody else, then it's worth it. I sign it. We send copies out for free. So passiveinvestingmastery.com/book. And you set up a meeting with me, get a copy of the book. If not just to talk to me, but Phil Collins, lead guitarist of Def Leppard, is on here. We have some NFL, NBA players, a lot of cool people, cooler than me, actual rock star, telling cool stories. Really enjoyed the project. But yeah, I love to talk with anybody, even if you're not an accredited investor. Everybody starts somewhere. I did too, right? I was not accredited when I started out, and I'm happy to have a call, understand your goals, and Julie and I both have a wide network. You're in great hands with Julie, by the way, but we both have a wide network. We can get you pointed in the right direction.
I love that. We do both have really great networks. And I always say, if I can't serve you, I have a great, powerful network. I can refer you out to somebody else who can serve your investor needs or whatever the needs are that I'm unable to. So, Patrick, thank you so much for, just coming and serving the conscious investor. I'm already turning into a passive investor over with you. I love it.
Yeah,
But thank you so much for coming on the show and pouring your wisdom, knowledge, and experience
I
into the
appreciate
conscious.
the invitation. Had such a great time once again.
Awesome. Conscious investor, remember, adventure belongs on the trail, not in your investing and not in your personal life. So if you're looking for support, don't hesitate. Go down to the show notes, schedule a time to chat with me. And that could be your first step, that could be your 10th step, whatever step it is. There's no reason to ever be stuck in life. And as I mentioned, if I don't have the resources to serve and support you, I am going to point you in a direction and make a connection that will help you become unstuck or get that momentum that you are looking for. So head on down to the show notes. Let's have a conversation soon. And until next time, cheers to your health, your mindset, and your wealth. Are you enjoying this episode? Help spread the word by sharing the episode with a friend or family member. Because really, where would any of our lives be without other people sharing great content with us? Help spread the word by sharing on your social platforms and with those you care about. And remember, tag me at Happy Julie Holly.